Hello, and thank you for joining us today. My name is Carol Ann Aldridge, and I'm one of the certified credit union financial counselors here at Alive Credit Union. Today we're going to be discussing your credit score and how we can make it work for you. To begin with, what is a credit score exactly? Well, a credit score is a number that lenders use to help them decide, if I give this person a loan, how likely is it that I will be paid back on time? These scores range from 300 to 850, and they're designed to give lenders a fast, accurate prediction of risk involved in giving a loan. As you can see, this is Alive Credit Union's credit score tiers. Best credit is a 710 or above, and then it goes down from there, 680 to 709. That's an A score. B score is 640 to 679. C score, 600 to 639. D score, 541 through 599. And lastly, the E scores, which are 541 and below. Now, with credit scores, there are three big reporting agencies that you've probably heard of: Equifax, Experian, and TransUnion. So what exactly is on these credit reports? Well, these credit reports are broken down into 5 major categories. The first category is identifying information. On this category, you're going to find your name and address, your social security number, your date of birth, and current and previous employers. Your second category is your summary. This is a brief snapshot of your credit history. It's going to show the number of delinquencies that you have on your report, any high credits, and any available capacities that you have with your credits. The next category is the public records. This is where lenders will be able to see your collection items, whether they were paid or not paid, if you've ever filed for bankruptcy, if you've ever had a foreclosure, which can stay on your credit report between 7 to 10 years, any judgments, and any tax liens you may have had, which can stay on your credit report for up to 15 years. The next category is your credit history / trade lines. This will show all current and past credit history for up to 10 years. This section includes date of the accounts when they were opened, the kind of credit, whether it's revolving or installment, if you have any individual or joint credit accounts, your balances, your limits, and your payments. And this is also going to give the lenders an accurate description of how well you pay your accounts. The last category is your inquiries. You're going to see your hard inquiries, which are initiated by you when you apply for credit, and soft inquiries. These soft inquiries are initiated by companies that want to send you promotional information or pre-qualified loans. I'm sure many of us have received many of those Capital One, You've Been Qualified credit cards. Those use soft inquiries. So what goes into your scoring factors? Well, your score is based on 5 different factors. The first being your payment history. Your payment history is the most important factor in credit scoring, as it makes up 35% of your score. The first thing that a lender will look for is how well your credit obligations have been paid. The more recent the slow pay, the larger the point deduction, with the most weight placed in the last 12 months. Keep in mind that just one 30-day late payment can devastate your score, and one slow payment will lower your score between 50 and 100 points. That's a drastic drop in your credit score. Some tips to kind of keep your payment history on track: obviously, pay your bills on time. This has the biggest effect on your credit score. If you've missed payments, get current and stay current, as older late pays become less significant. Keep in mind, paying off a collection account won't completely remove it from the credit report, and it can stay on there for up to 7 years. And most importantly, if you're having problems paying your bills, contact your creditors to work out arrangements. Don't wait until it's too late. The next factor is your level of indebtedness. This represents 30% of your score. Your level of indebtedness means your average balance on your credit cards and your ratio of balance to limits. An example, say you have 2 credit cards, each with a $1,000 limit. On one credit card, you have it maxed out to $1,000, and the other you have 0. Your capacity is 50%. Now, also, if you decide to close that card that has the 0 balance, that will bring your capacity to 100%. You don't want this. Next, we have your length of credit history. This makes up 15% of your score. This is going to include the number of months in your credit file, the average age of installment loans, and the length of your oldest bank card. Now, credit scoring takes into account the age of your oldest trade line and the average age of all your accounts. Don't apply for unnecessary credit accounts. New accounts lower the average age of your credit history, and having a shallow credit history has an even larger effect on your score. Some tips when it comes to the length of your credit: before you close out any credit card, look to see if it'll change your capacity. Remember the example from earlier? Your capacity was at 50% when you maxed out one card and then had a 0 balance on the other. But once you closed out the 0 balance card, your capacity jumped to 100%. Also, never close out your oldest credit card. And don't continually open new credit cards or transfer balances, as it lowers your capacity and then it lowers the age of the credit. The next category is new credit. This represents 10% of your score. This is going to show lenders the number of inquiries in the last 6 months and the number of trade lines opened in the last year. And lastly, the last category of your credit score is the types of credit. This is going to show the number of personal finance companies, the percent of trade lines that are revolving, and any installment loans that you may have. Consider this. Installment loans are considered good on your credit report, and revolving loans are considered bad. If you have lots of small credit card debt, consider consolidating it into a personal installment loan. This is a quick way that you can improve your score. So now that we've talked about what's in your credit score, what's not in your score? What's not in your score is race, religion, nationality, sex, or your marital status, your age, your employment, your salary, occupation, title, or length of your employment, where you live, or any debt management companies that you may be working with. None of these make up what your credit score is. Some other tips that we have for you include: if you have kids in high school or college, you can add them as an authorized user to one of your cards. And also, don't make any large credit card purchases at least 2 months prior to getting a mortgage. This will decrease your capacity and can lower your score. As a consumer, it is your responsibility to know your score. Obtain a copy of your credit report at least once a year. Keep in mind that if you do find any errors, it can take as long as 30 days to correct. If you plan on making a large purchase, such as buying a car or a mortgage, it's also very beneficial for you to know your score. Not knowing what rate you qualify for could cost you thousands. Now, speaking of errors and disputes, keep in mind that when you find an error and you reach out to that lender, they must respond within 30 days. If you are in the process of applying for a loan, immediately notify your lender of any incorrect information in your report. The lender will need to reorder your credit report and score once any changes have been made to your information at the consumer reporting agencies. Now comes the fun part: repairing bad credit. The most reliable help for restoring credit will come from Father Time. Repairing your poor credit does not happen overnight. Your first step is bringing your payments up to date and keeping them current. Eventually, negative information on your credit report will be deleted and only positive information will remain. Adding a string of on-time payments will counter those old delinquencies. Something we also suggest is you can get a secure credit card to help reestablish your credit. Beware that low limits and high balances will lower your score. Now, how can we maximize your score? As we've mentioned already, pay your bills on time or make arrangements with your creditors before you're reported delinquent. Keep your unsecured balances below 30%. Keep old trade lines open because closing them reduces the average age of your credit. Avoid finance companies. Avoid opening department store cards. And again, pay your bills on time. As a consumer, you're also entitled to get a free credit report each year. Visit www.annualcreditreport.com to view your credit reports. Now, another important factor in reviewing your credit reports is it also protects you from identity theft. Identity theft is one of the fastest growing crimes in the United States. By checking your credit report regularly, this helps detect identity theft red flags. For example, if you notice an unknown account shows up on your report, strange account activity, or overall inaccuracies. And lastly, our piece of advice is to opt out of pre-approved offers. We mentioned earlier that there are soft inquiries on your credit report. Oftentimes, these are the pre-approved credit cards. You can opt out by calling 1-888-567-8688 or by visiting www.optoutprescreen.com. You will need to provide your name, address, social security number, date of birth, and phone number. This will opt you out for 5 years or life. This concludes our presentation on your credit score and how you can make it work for you. We hope that you've learned a lot of valuable information that will help you lead financially fit lives and help improve any obstacles that you may have regarding your credit history. If you have any questions, please contact us at 904-296-1292, option 3, to speak to one of our certified financial coaches that would be more than happy to help you. Hello, and thank you for joining us today.